Imagine your country's economy is in crisis. Enter the IMF, offering a lifeline, money to keep things afloat. On the surface, it's a global safety net, but is it really a rescue or a leash? The IMF's help often comes with strings attached, strings that let it steer a nation's policies for years. For many countries, an IMF bailout means promises of stability, but the reality is often debt, austerity, and lost control. So is the IMF a healer or a loan shark in a suit? Let's pull back the curtain and find out. Because this isn't just about economics, it's about real lives and who gets to decide a nation's future. To understand the IMF, let's rewind to 1944, when world leaders created it to stabilize currencies and offer short-term loans. Originally, the IMF was a quiet financial referee, but after the 1970s, as global crises hit, it reinvented itself as the world's emergency lender. With the US as its biggest shareholder, the IMF's influence grew, along with its power to dictate economic policy. Soon countries needed the IMF's approval to access other loans, giving it immense leverage. The IMF became the gatekeeper of global finance, deciding who gets help and on what terms. Its mission shifted from stability to enforcing a Western model of capitalism. And often, the ride it offers takes countries somewhere they never intended to go. When a country gets an IMF loan, it comes with a thick binder of conditions, known as structural adjustment programs. These reforms mean deep budget cuts, slashing public services, and removing subsidies for essentials like food and fuel. Privatization is next. State assets are sold, often to foreign companies, making basic services pricier and less accessible. Trade liberalization opens the door to foreign competition, hurting local businesses and farmers. Currency devaluation and high interest rates follow, making imports costly and stifling local growth. The result? A country's economy is reshaped to serve creditors, not its own people. The IMF prescribes the medicine, but it's ordinary citizens who suffer the side effects. For many, the cure feels worse than the disease. The IMF's policies have real painful consequences. In Jamaica, IMF-mandated trade liberalization destroyed local agriculture, making the country dependent on imports and crippling farmers. Greece's bailout came with brutal austerity, pensions slashed, unemployment soared, and hospitals ran out of supplies. Most bailout money went to foreign banks, not the Greek people. In Pakistan, repeated IMF loans mean constant austerity, higher fuel prices, mass protests, and a cycle of debt that never ends. Across these countries, the pattern is clear. IMF help often means social progress reverses, inequality grows, and sovereignty erodes. Decisions shift from elected leaders to distant economists, prioritizing creditors over citizens. The IMF isn't just restructuring economies, it's reshaping societies, often at great human cost. The question remains, who is the IMF really helping? The IMF trap is hard to escape. Austerity shrinks economies, making debt harder to repay. As revenues fall, countries need new loans just to pay old ones, creating a debt spiral. Each new loan brings harsher conditions, locking nations into permanent austerity. Money that should fund schools and hospitals instead pays foreign creditors. The real winners? International banks and financial institutions, not the people living under austerity. The IMF acts as a global debt collector, protecting big lenders while ordinary citizens bear the cost. It's a system that keeps poor countries poor and dependent. Is escape possible? Sometimes. Argentina and Malaysia defied the IMF and found alternative paths, but at a cost. Rejecting the IMF can mean financial isolation, but today, countries have new options, like loans from China. China's loans come with fewer policy demands, but critics warn of debt trap diplomacy, where default means losing control of key assets. Whether the lender is in Washington or Beijing, the power imbalance remains. True financial sovereignty means choosing your own path, not just swapping one creditor for another. The rise of alternatives challenges the old model, but the lesson is clear. Always read the fine print. Too often, rescue packages help the lenders more than the people in need.